Welcome back. My name's Chris Gosselin from Australian Fund Monitors. Today we're talking to Michael Poulsen. Michael, welcome.
Thanks for having me.
Michael, tell us a bit about Canopy. It's a relatively new strategy or new fund under the Bennelong umbrella.
Yes.
But you've got a long track record previously working with your colleague Chris at another major fund manager.
At Magellan, yeah.
At Magellan,
Yes.
Okay. How was that?
It was good, yeah. So I was at Magellan for over 10 years. Chris was at Magellan for 15 years. Our third colleague, Jack, was also at Magellan for about 10 years. So we've all worked together as a team for a long time. We know each other very well, for better or for worse. Starting my career, Chris and I picked technology stocks, working for the main global fund at Magellan. This is kind of from 2012 that I started there, in Sydney and in New York as well. And of course, that was a very fruitful time for large cap technology stocks, some of the best performers in the global fund over that period. We had a direct hand in, so companies like Microsoft and Apple. Coming back to Sydney after our time in the States, we were ready to run our own fund. So we ran a long-short fund internally at Magellan from 2019, and ultimately pivoting in 2022 to run the Canopy small and mid-cap fund strategy that we now run. That started at Magellan. So it was a good time, good experience.
So it's quite a change from going large cap tech stocks to your current strategy, which is small, mid-cap, global. Why the change and what's the opportunity?
So I should clarify. So the long-short strategy that we're running from 2019, that was all cap. And so that was a great experience in small and mid-cap companies. I also think short selling is a great discipline, even though we're long only now. That's a great discipline for any investor. The other clarification would be that small and mid-cap, sometimes there's a misinterpretation among Australian investors thinking that these are really, really small companies. We go up to $70 billion US dollars. That's the classification of mid-cap. And the median company in our portfolio is about $17 billion US dollars. So these are all strong, established companies. They tend to have been around for a long time. Typically what you find is that they might only operate in a single geography, or they might specialize in a particular niche. So, long track records and operating history, just not as big as NVIDIA or Microsoft.
And what's the benefit of focusing on that market segment?
So the starting point is that over a long period of time, smaller companies have been shown to outperform larger companies. So that's the starting point, is that the results have been good. In the US, for example, there's data going back to the 1920s showing that smaller companies have outperformed. And we think that that's owing to structural reasons and is durable. So smaller companies tend to be less widely covered, of course, than the larger companies in the world, the Magnificent Seven. So you've got fewer analysts that are looking at them, which means that there's higher potential for mispricing. These are companies that tend often to have longer growth runway, by definition, being smaller. They're often takeover targets as well, and we know that the targets capture most of the value in takeovers. So there's a lot of potential for good results. The other factor at the moment is that valuations are particularly attractive at the small and mid-cap end of the market globally. So if you look over the course of the last 20 years, small and mid-cap companies have tended on average to trade at a PE premium to larger companies. That is currently a PE discount. So we think that there's good reason to expect that valuation discount to close over time, and that will be hopefully a tailwind to global small and mid caps.
So Tell us about the actual construction of the portfolio. How many positions do you have in the portfolio? What sort of concentration do you have?
Yeah, so the main points are, as I said, so we go from 1 billion market cap up to 70 billion market cap. 20 to 40 positions on average. It's long only, so relatively concentrated. We are absolute return focused. So we have a target of achieving double-digit returns over time. We're benchmark unaware. And so what we're really trying to do, and a quality-focused fund as well. So we're trying to form a portfolio of quality companies that are trading at attractive prices, where we think that we can achieve double-digit returns over time, risk managed in a way that is going to protect investors.
How large is the universe for you? So how many companies fit into that area globally?
So it's pretty big. It's in our index is 7,500 companies. We apply market cap and volume filters, but you still end up with a few thousand companies. So tools are important to help you prioritize research when you're dealing with so many companies. And I'm happy to talk about some of the tools that we're using. It's developed markets. So you've got, more than 20 countries globally that we're investing in. So a lot of opportunity.
And what's the geographic mix? Is most of your portfolio invested in American companies?
Yeah, so of our opportunity sets, of those 7,500 that I spoke about, it would be 60 to 70% is based in the US. So it's the single largest country in our opportunity set. It's also the single largest representation in our fund. We're a little underweight, but it would be kind of 60% by domicile. The residual is mostly Europe, and then you've got a smaller, APAC is a relatively smaller component, kind of 10 to 15%. We have less exposure in Asia Pacific, and part of that is that we don't invest in Australia. We look for investments outside Australia.
Are you focusing on specific industries, or are you agnostic about the industry that the companies?
So we will invest across sectors. So the long short and fund that I mentioned earlier that we're running, we're generalists for this fund as well. So tech's a component, but it's not the only component. We will be led wherever we feel as though there are good companies. And so investing across most industries. What I'll say that we don't do a heap of is we tend not to find high concentration of good companies in energy and materials. We tend to stay away from very heavily regulated industries as well, so things like utilities and so on. Real estate, we have one REIT, but it's not a very REIT-y REIT. So we'll go wherever the good companies are, but there are some subsectors where we tend not to have a focus. And the other bit is, where can we add value? So us trying to pick the trajectory of commodity prices or something like that, we don't feel as though we have a competitive advantage there, and we don't do it.
Let's just turn to the current market. You've given a really good explanation of where you do invest, where you don't invest. How's the current market playing, or how are you managing the current market?
It's certainly volatile. I'll give you that. The starting point is the approach and objective of the fund, which is investing for the long term, and with a quality focus. And so in a way, we were quite well positioned because we are investing in some of the best companies in the world, some of the most profitable companies in the world. This is where quality investing actually really matters. You can sleep well at night knowing that your companies are still going to have a competitive advantage and still be profitable and have good balance sheets when you wake up. So we're not macroeconomists. We don't try and predict outcomes. That being said, we were quite well positioned for this type of volatile environment. there hasn't been a whole heap that we've had to change in the portfolio that we felt compelled to do. That being said, prices and movements in prices sometimes dictate that you should be thinking about things. And so that has been a matter of tilting the portfolio to areas where we feel as though the baby's been thrown out with the bathwater. And so that could be a really good company where you feel as though it's just been sold off unnecessarily. And the other thing that we find, which is maybe a little bit counterintuitive, is companies that are relatively more defensive and hold up in volatile environments like this can be funding sources for some of our high quality companies that have just been whacked in the volatility. So I'd say for us, it's leaning in a direction, but not wholesale changes.
So you probably look at the current volatility as opportunity rather than risk, or are you just balancing the two?
I would say there is definitely a lot of opportunity, but you have to be mindful equally of not getting over your skis when anything can really happen in the near term. But there's certainly more opportunity.
Michael, it's an interesting time to start a new fund. Had you known that the Trump uncertainty was going to unleash itself on the world, would you have done anything differently?
I don't think drastically so. The tariff regime, maybe starting with that because that's more proximate to this conversation, that had been flagged that there was going to be an announcement. And so like any sensible investor, we had been through the portfolio and confirmed that we were comfortable with everything that was there. So I don't think that there's anything drastically different that we would have done. Certainly the last call it 10 months has really been two quite different stories. It's amazing that we've gone from a narrative so widely held of US exceptionalism in the back half of last year to all of a sudden that narrative being challenged. So I don't think that we would have changed anything drastically different, done anything drastically differently. And if anything, being through this period has highlighted the importance of having a philosophy and sticking with it, investing in good companies at attractive prices, and managing your risk, because things can change quickly.
So don't panic.
Yeah, don't panic. History has shown that periods like this have tended to be opportunities, but you have to make sure that you're in a position to be able to take advantage of them.
Can I just turn to your relationship with Bennelong?
Yes.
And how that works?
When we were setting up Canopy, it was clear to us that we wanted to partner with someone. We had been through the process, or Chris more so than I, being quite early at Magellan and understanding how the sausage is made and how much work goes into operations and compliance and so on. And it's incredibly time consuming, and that's not somewhere where we wanted to spend our time. So it was clear to us that we wanted to partner. Bennelong has been the perfect partner for us because they're big, they're well established, they have some great funds. They didn't have a global equities offering in the space that we were in. So the partnership for us is top-notch operations and compliance. We can focus on doing the investing. Bennelong also has a distribution and marketing capability, which is attractive as well. So it's been the perfect partnership for us.
Retail fund?
Yep, retail fund. Yep.
Minimum investment?
Yeah, yep. $20,000 off the top of my head. We have a unit class that's available through to the middle of the year with a lower fee for a higher minimum. That's $250,000, which some of your clients might be interested in. So yeah, two unit classes, lower minimum is a 1.1% management fee and a 15% performance fee. And the wholesale class with the higher minimum is about half the management fee.
Michael, really nice to speak with you. We wish you all the best with the fund.
Thanks, Chris. Thanks for having me.
Thank you. Until we meet with our next manager.